Hey folks, Brett Pattison here with Iron Gate Global Advisors. The market, as I speak, is trading near all-time highs. A question I've received lately is now a good time to buy stocks or should you wait? We'll address that very topic today and much, much more in this month's market commentary. Hey folks, we're coming at you from the financial capital of the West. Thanks for listening today. It is the best and worst time of the year. I'll explain what that means. But first, know that anything that I discuss, or my partner Brian, who is joining us today as well, understand that there's a process for investing. This process that we follow is not results driven. We don't chase returns. Rather, we focus on the probabilities of making money. What kind of trades, whether they be option trades or stock investments, have a higher probability of making money than losing money? That's what we focus on. That's what our day is about. Let's take a look at those probabilities right now as we look at the historical S&P 500 averages since the early 1900s. Again, we look at the past to help us make decisions for the future. Doesn't hold true every time, but certainly the probabilities put the edge in your favor if you understand them. In September is typically a pretty volatile month. Down 0.5% for September, October up 0.7%. September and October, think about what's happening in those months. Summer's over. There's an election this year, so uncertainty could creep its ugly head, creating volatility, which would keep those numbers in line with historical average. Now, the cool thing about September and October in the markets is that they end, and that concludes the worst time of the year for stocks. The best time of the year for stocks is November, which averages 1.5%, and December, 1.7% returns on average. So if you think about it, September and October help provide an opportunity for us as we look to November, December, and beyond. And how happy I would be if volatility comes to the markets in September. We've gone nowhere but essentially up for 2 months since Brexit. No volatility, no great buying opportunities, no great option opportunities. I would love for September to be volatile. If it is, don't freak out. Know that we're taking advantage of it on our end. Now, let's get to the important stuff. The market, like I mentioned, has gone nowhere but essentially up since Brexit. It's trading near all-time highs. The question that we have is, now a great opportunity to buy, or should we wait? And it all comes down to understanding the value of the market and finding opportunities that are below that current value in the market. And I'm not going to explain it. My partner Brian Hunsaker is going to explain 3 things that we look at to help determine whether the market is expensive or whether it's cheap.
Okay, Brian Hunsaker here from the financial capital of the West, Salt Lake City. I stole that from my partner, Brett Pattison. So there's 3 things that we look at when we're determining the overall value of the market. And let me also say that we typically don't buy the market. We are buying individual stocks. I think that's important to say. But every one of our stocks trade in the market, and they are influenced by overall market levels. So the first thing we look at is the price earnings multiple. And this is a historical chart that goes back to 1960 through 2016. And you can see that there have been some times where the PE multiple has been relatively low, below 10 times earnings. And you can see that if it trades above 15, that's typically kind of a break point where we see the market trading above and below 15. That kind of looks like an average if you were to look at it over time. So right now the market is trading over that 15 times, and I would say that would probably be a negative to the overall PE multiple if we're looking at it from that standpoint. Let me just say that, ask the question, what is the PE multiple or price to earnings multiple, and what does it mean? And first of all, it's just a simple calculation of price divided by earnings. And earnings are just the profits of a company that they generate over the previous 12 months. So those are profits, and it's on a per share basis. So if you have a company that earned, say, $100 million and they had, say, 100 shares outstanding, so that would be $1 million in earnings per share for that company for that particular year. So it's just a calculation. Of course, most companies have many more shares than just, say, 100 shares. They have thousands, hundreds of thousands of shares that are outstanding. So I would say that the first thing we look at is the PE multiple would probably be a negative from a historical standpoint as far as the overall market level. The second thing we look at is the earnings growth. And the earnings growth actually is pretty consistent. Now, this is a 15-year earnings per share, rolling earnings per share growth chart. And you can see that the market or the overall economy and profits of companies typically will grow between 4 and 6%. Now, there are periods of time where it grows greater than that, 8%, and a few times even higher than that. Currently, over the last several years, we've been in the range of between 4 and 6%, which is not huge, but actually pretty good, and it's pretty consistent going back to 1975. I would say that the last 5 or 6 years have been maybe a little below that, and I would say there's probably a trend that the larger the U.S. economy gets, that I think that it becomes harder to grow at a higher rate, and we're a very large, mature economy, and so I think that that's to be expected to some degree. But I don't expect that to change a whole lot. I would say between 4 and 6% is probably what we can expect going forward. Of course, there will be periods of time where that's higher and lower. And I would say that that's actually a positive sign for the overall market, what we're seeing currently. And then the last thing we look at is the 10-year Treasury versus the earnings yield. And the 10-year Treasury currently is about 1.6%. And you can see we're at historical all-time lows. And then you see this blue line, which is the earnings yield. And all that is just the inverse of the PE multiple. It's just earnings divided by the price. And that gives you a percentage, just like an interest rate. And you can see that we're currently around 5-something% on the earnings yield. And it's actually a pretty historic high. The difference between the 10-year Treasury, which we also call the risk-free rate of return, and the earnings yield is a pretty high margin right now. And so I would say that's a pretty positive thing. And so I think so if I take all three of those things together, I would say that the market overall is trading in a range of fair value, maybe on the high side of fair value. We have two positive things. One is interest rates are very low, and the earnings yield is pretty attractive versus the risk-free rate of return, which is the 10-year Treasury. And it's also a positive factor when we look at the growth rate. The negative factor is the PE multiples are pretty. The market recognizes these things, and the market's paying a higher price for these because of these positive things, and low interest rates and relatively good earnings growth over time. Now, we've seen earnings growth kind of stall out the last year or two. So in conclusion, what are we doing in our portfolios? Well, we are being patient. We think that stocks are fairly valued, like I've said earlier. But we also know that the market can change its mind in a very rapid amount of time, and stocks can get cheaper pretty quickly. And so we're waiting for opportunities like what we saw in February, and like what we saw about a year ago in last September. We saw stocks go down, and we were adding to positions at that time. The other thing we don't want to do is just buy things that just because we've got to put money to work and it's burning a hole in our pocket. We want to wait and be patient and do things that make sense. Don't make mistakes. Be patient, and to be smart about your money. And then that part of being smart about our money is it's okay to hold cash for shorter periods of time or intermediate periods of time. We don't want to hold cash for years and years on end. that's a poor use of money. But we think it's okay to do that over a short period of time and wait for good opportunities. And so we're doing that, and it'll make sense, we think, in the long term. And that's proven to be the case during my career.
Well, thank you, Brian, for that insight on the market. And he summarized it well with what we're doing right now in client portfolios. Certainly, that's not a recommendation or advice to you if you're managing your own money. And if you have any questions for us and would like to talk one-on-one to either Brian or myself, there's our contact information. We'd be more than happy to do so. Certainly, we have a lot to offer here at Iron Gate Global Advisors. We look forward to hearing from you. Relax. We can take it from here.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.